If cash flow is tight, Redraw might be the way to go. If you can manage those increased repayments, then the offset facility gives you greater flexibility. Hi there. Over the next 2 installments, I'm going to go through something that's really important for people who are looking to borrow and invest and to structure their loans most tax effectively. The 2 main types of loans are offsets and also redraw facilities. I'm going to run through in this installment the key definitions and how they look side by side. Firstly, with regard to the loan facility, what's important to understand there is that the loan facility itself is the maximum that you're allowed to borrow under that loan account. In the example that we're using, we are talking about a loan facility of $800,000. When we look at a redraw facility is one account. If you have paid down an amount of $200,000, in our example, the account statement would show an amount of $600,000 as owing, and there'd be a redraw facility of $200,000 showing a total amount available of $800,000. When we look at an offset facility, the amount that you have as your loan facility, being the $800,000, sits in a separate account to the deposit account of $200,000. The net amount owing remains the same, the $600,000, but they are 2 separate accounts, and this is quite an important distinction. When we look at the key differences between these 2 types of loans, the first thing to consider are the repayments. And with a redraw facility, the actual loan balance is the smaller amount, the $600,000, and your loan repayments would therefore be payable based on the $600,000 amount outstanding. With the offset facility, the loan amount is actually the $800,000, the original $800,000, and therefore your loan repayments would be based on the full $800,000 amount. We then need to consider the interest payable by you to the bank. In the redraw facility example, we note that the amount owing is the $600,000 and the interest charged would be based on that $600,000 amount. Equally, in the offset example, the net amount owing to the bank is still the $600,000, and therefore, in that instance, the interest charged would be based on that $600,000 net amount. In both instances, the interest charged would be the same. The result of this is, in a redraw facility, the repayments are lower, offset repayments are higher, while the interest repayments remain the same in both instances. While there's the different cash flow profile, what an offset account does for you is it offers you greater flexibility. And we see that this is extremely important and extremely valuable for clients as they move through different life stages. It might be that they own a property, it might be their first property, at which point it might be their principal residence. They get to a point where they've paid down part of the loan or they've got increased income coming in, and at that point they look to upgrade their home. By having that offset in place and paying money into that offset account rather than paying down the redraw, there are some significant tax implications, and we'll run through those next week. So with the redraw facility, when you make extra payments to that or when you put money into that redraw facility, you are actually paying down the loan, and drawing that money out later might have tax implications. With the offset facility, it actually keeps your cash separate. What you do with that money from there is of no consequence, and therefore there's not too much difference in terms of tax implications whether you drag that money out to buy a boat or to buy shares. Again, there's some really important structuring that we can do in terms of that if you were to buy an income producing asset that mean that we need to do things in a certain order in order to gain the best tax outcome. If cash flow is tight, redraw might be the way to go because there are lower monthly repayments. If you can manage those increased repayments, then the offset facility gives you greater flexibility moving forward. And this can be greater flexibility for the life of the loan. If you're able to do that, that is the way to go. And we'll have a look at how that might benefit you down the track in our next installment. In the next video, I'll drill down further into a strategy that will help you get the best out of the offset facility on TC, and that's my 2 cents. Now, before you jump, if you found this useful, like or subscribe and share with anyone who might be interested. The content is for information purposes only. Get your own specific tailored advice. This is not financial advice. I am a poor, simple bean counter and not a substitute for good quality financial advice. If you've got a question or a topic that you'd like me to cover, set it out below or send me an email at tcs2cents.com.au. If you're looking for tailored guidance to boost your business or tax advice or tax results, visit atomicba.au or email us at admin@atomicba.au and see if our team can help you go to the next level.